Welcome to this segment from the Europe's Innovation Gap: Why the EU Trails the US and East Asia in Tech series. To make this deep dive more accessible, I've broken the full video into smaller, focused chapters. If you're interested in the full story, from overregulation to the rise of unicorn startups, you can find the complete video on my channel. Today, we are talking about Chapter 3, the venture capital and startup shortfall. Why is it so much harder to build a billion-dollar company in Europe? In this chapter, we'll dig into the startup scene.
The venture capital and startup shortfall.
Innovation isn't just about R&D labs, it's also about startups, venture capital, VC investment, and the ability to turn ideas into high-growth companies. And this is another area where the EU lags starkly. Simply put, Europe has fewer startups, especially unicorn startups, and far less VC funding than the US or China. This venture gap is both a symptom and a cause of Europe's broader innovation troubles. Consider this. In 2023, 66% of the world's active unicorns, that is, startups valued over USD 1 billion, were American. 26% were Chinese, and only 8% were European. That's an astonishing disparity. The birthplace of Airbus and Nokia is now producing barely 1/10 the number of billion-dollar tech firms that the US is. Why? Capital and market scale. Venture capital is the lifeblood of Silicon Valley's rapid innovation. VC investors raise large funds and are willing to take big risks on unproven ideas in exchange for big equity stakes if those bets succeed. The US has an enormous VC industry. China's VC scene has exploded in the last decade as well. Europe's venture capital sector, however, developed later and remains much smaller. According to one report, only 5% of global venture capital investment goes to EU-based companies, versus 52% to US companies and 40% to Chinese. In other words, global investors pour 10 times more money into the US startup ecosystem than into Europe's annually. Even allowing for Europe's smaller economy, VC investment per capita, or per GDP in the EU, is a fraction of that in America. Look at this comparison of annual startup investment, venture capital, in North America versus Europe. In this bar chart, pink bars represent North America, blue bars, Europe, including the UK, from 2016 to 2021. We see North America's VC funding climbing steeply to over $300 billion by 2021, while Europe's rises much more modestly to around $100 billion. Europe consistently attracts roughly 1/3 or less of the venture funding that North America does. This gap means fewer European startups get the fuel needed to become the next tech giants. Even in 2021, a record year for European tech, North America's lead was enormous. Visualizing this gap highlights how undercapitalized Europe's startup scene remains, which directly impacts its ability to innovate at scale. Less venture money means fewer startups can scale up in Europe. A tech founder in Europe often finds that to raise a large Series C or D round, the kind needed to become a unicorn, they might have to court US or Asian investors or even relocate to the US market. It's no surprise then that many European-born startups move their headquarters to the US once they start succeeding. The EU itself acknowledges this scale-up problem. Promising companies founded in Europe often leave for America to access bigger markets and deeper capital. This represents a brain drain and loss of economic potential just when these firms are poised for rapid growth. Why is European venture capital weaker? Several reasons. Cultural and legal factors, we'll dive deeper into culture in the next section, make European investors more risk-averse. Pension funds and big institutions in Europe historically invested less in VC, preferring safer assets, so VC funds had less capital to deploy. Fragmented markets. A startup in Europe faces 27 different countries, different languages, regulations, consumer preferences, which makes scaling slower and less attractive. So the potential returns for a VC backing a European startup might be lower than backing a US startup that can immediately scale across a huge unified market. We see an exception in sectors where Europe did unify, like fintech, under common regulations. And indeed, fintech has been a relative bright spot for EU startups. Fewer big tech acquirers. In the US, even if a startup doesn't IPO, it might get bought by Google, Facebook, Apple, etc. China similarly has Baidu, Baidu, Alibaba, Tencent, and others snapping up startups. Europe has fewer deep-pocketed tech giants to serve as acquirers, which makes VC exits harder. Though EU corporates like Siemens or SAP do some acquisitions, it's not at Silicon Valley scale. Ecosystem maturity. Silicon Valley has had 60+ years to build a virtuous cycle of successful founders becoming angel investors or VC partners to the next generation. Europe's ecosystems are younger and still catching up, though cities like London, Berlin, and Stockholm are now producing such cycles. Let's look at concrete numbers. In 2022, venture capital investment was about USD 233 per capita in the US, but only around $50 per capita in Western Europe. Illustrative figures. The total VC raised by European startups in 2022 was around USD 85 billion versus over $200 billion in the US, and roughly 50 to 60 billion US dollars in China, though China's numbers fluctuated. Europe has been improving. A decade ago, those numbers were far smaller, but the gap remains huge. Another metric: number of unicorns. The US hosts well over 600 unicorns as of the mid-2020s. China has 200 plus, India around 70. By contrast, the entire EU, 27 countries combined, had around 50 to 100 unicorns, depending on the source and year. The UK alone, now outside the EU, has been punching above its weight with 50 plus unicorns. And even tiny Israel, not in the EU, but often compared to Europe, has around 100 unicorns, reflecting its strong startup culture. In fact, Israel and the UK individually have unicorn ecosystem valuations that surpass those of Germany or France. According to one ranking, Germany and France are only the 4th and 6th in Europe in terms of total unicorn market cap, lagging behind the UK and Israel. This is striking given Germany and France's size. It highlights how even within Europe, the startup landscape is uneven, with some pockets, London, Tel Aviv, Stockholm, far more dynamic than others. The venture capital shortfall also ties back to regulation and funding models. European pension regulations traditionally made it harder for funds to invest in riskier VC. And while the EU has tried to spur VC with public programs, like the European Investment Fund co-investing in VC funds, it's still not a substitute for organic, private risk-taking. As a result, late-stage funding is especially scarce in Europe. Many startups can get seed funding or Series A in Europe. But when they need USD 100 million plus growth rounds, there are fewer local players who can write that check. A Politico analysis put it plainly, quote, Europe lags significantly behind the US in the availability of venture capital, especially in later rounds. Fragmentation exacerbates this. There is no single European Nasdaq or large unified stock market for tech. Instead, successful European startups often list on the Nasdaq in New York or get acquired. So the whole innovation to capital pipeline is weaker, from VC to IPO. All of this means fewer European startups make it to the big leagues. And those that do often cease to be European in a sense. For example, Skype was founded in Europe but got acquired by eBay/Microsoft. DeepMind, AI pioneer, started in London but Google bought it. TransferWise, now Wise, moved significant operations to the US. Spotify, while still European, listed on the NYSE. It's a pattern of Europe acting as a tech incubator for others to harvest. To illustrate with a visual metaphor, if innovation were a race, Europe's startups are running with weights on their ankles. Less fuel, VC money, hurdles on the track, regulations, fragmented markets, and fewer cheerleaders on the sidelines, investor community, compared to the US and China. Despite these hindrances, some do succeed. Europe has produced great companies like ASML, world-leading semiconductor equipment from Netherlands, Spotify, Sweden, Adyen, Netherlands, BioNTech, Germany, etc. But the question is scale and frequency. The data show these successes are the exception, not the rule, compared to the thriving startup cultures in America or East Asia. Case study Unicorn Counts and Valuations. A dataset from 2022 showed that the combined valuation of all European unicorns was around USD 700 billion, whereas US unicorns totaled over USD 2.6 trillion in value. Europe's entire stable of unicorns was worth roughly the same as just the top 5 US tech companies. That points to not only fewer unicorns, but generally smaller ones. European startups may sell earlier or address smaller markets, limiting their upside. To sum up, Europe's venture and startup ecosystem, while growing, is still punching below its weight. The continent lacks a deep pool of risk capital and has yet to produce the volume of high-flying startups seen in the US or China. This is both a result of the regulatory funding issues discussed earlier and a cause of Europe's slower innovation output. Fewer startups means fewer disruptive innovations challenging incumbents. Before moving on, it's worth noting this isn't just about making billionaires. A vibrant startup scene feeds back into the whole economy. It creates jobs, drives new technologies, and pressures established companies to innovate more themselves. Europe's big corporations, automakers, banks, etc., face less challenge from upstarts, which can lead to complacency. In the US, for example, Tesla's rise forced the entire global auto industry, including Europe's, to accelerate electric vehicle innovation. If Tesla had been a European startup, would it have gotten the capital and support to disrupt incumbents? Many doubt it. Europe's Elon Musk might still be filling out grant applications. If you found this chapter interesting, consider watching the full deep dive, where I cover everything from Europe's startup gap to case studies comparing the EU, US, and Asia. You'll find the link in the description. And hey, if you like this kind of content, smash that like button, subscribe for more deep dives, and let me know your thoughts in the comments. Cheers, and see you in the next one.